U.S. housing market trends and challenges. In September, the U.S. housing market showed signs of slowing growth, with home prices continuing their downward trend. According to the latest data from the S&P CoreLogic Case-Shiller U.S. National Home Price NSA Index, home prices experienced an annual increase of just 3.9%. This marks a decline from August's annual gain of 4.3%. Looking at the month-to-month progression, home prices saw a slight uptick of 0.3%, when adjustments are made for seasonal variations, indicating a small recovery from the previous month's figures. The data also highlights regional variations. The index, which includes home prices in two major composites, 20 cities and 10 cities, recorded increases of 0.2% and 0.1% respectively, stressing the competitive nature of the market in these urban areas. As we dig deeper into the trends shaping today's market, it's essential to recognize the broader implications of these statistics. A slower pace of home price growth could suggest a cooling market, which might be welcomed by potential buyers who have faced soaring prices over the past few years. However, with rising interest rates, the landscape remains complex for developers and first-time buyers alike. In other news, new home sales took a significant hit in October, illustrating further challenges in the housing sector. The numbers show that prospective buyers are becoming increasingly cautious, leading to plummeting sales figures. This downturn could be influenced by various factors, including higher mortgage rates and an uncertain economic climate. Meanwhile, agencies like Fannie Mae and Freddie Mac are also taking steps to improve housing opportunities in the market. They've recently published 3-year plans aimed at expanding access for potential homeowners. These initiatives are crucial in fostering a more inclusive housing market, especially as many individuals find themselves navigating the challenges of affordability. Industry shifts continue as Kind Lending welcomes its new branch manager, Jen Steers, signaling possible changes in their approach to lending. Leadership transitions can often herald new strategies and initiatives, which could influence the lending landscape and ultimately impact home buyers. Moreover, the government-sponsored enterprises, GSEs, are expanding eligibility for appraisal waivers on purchase loans, making it easier for certain buyers to navigate the purchase process without the typical financial burdens associated with conventional appraisals. This adjustment could streamline transactions and attract more interest in home buying amidst a fluctuating market. Nonetheless, caution remains prevalent among lenders, as evidenced by the tightening of mortgage credit in September. In a response to evolving market conditions and rising rates, lenders are more stringent in their credit assessments, further complicating the equation for buyers looking to enter the market. As we consider these dynamic shifts, it's crucial to highlight that the average monthly housing payment has surged by 20% since 2020. This sharp increase reflects not just rising prices, but also the impact of higher interest rates on monthly mortgage payments. Such costs weigh heavily on buyers' decisions, compelling them to reassess their budgets and purchasing power. Lastly, CoreLogic's findings on home price growth in August also reveal a muted increase, emphasizing that the trend of slower growth is not a mere anomaly, but rather a consistent pattern. As the landscape continues to evolve, the delicate balance of supply, demand, and economic indicators will play a pivotal role in shaping the future of the housing market. Stay tuned as we keep you updated on these trends and provide insights to navigate the complexities of today's real estate landscape. As we dive deeper into the housing market trends, it's interesting to note the significant year-over-year changes among major cities. The 10-city composite experienced an annual increase of 5.2%, while the broader 20-city composite saw a 4.6% rise. New York led the pack, showcasing a remarkable 7.5% increase in home prices in September. Following closely behind were Cleveland and Chicago, with annual gains of 7.1% and 6.9%, respectively. This demonstrates a vibrant real estate market in these metropolitan areas. However, not all cities experienced such growth. Denver recorded the smallest increase, with a modest 0.2%. Brian D. Luke, a prominent figure in the finance sector, shares a valuable perspective on these trends. He notes, home price growth stalled in the third quarter after a steady start to 2024. This observation highlights a shift in the market dynamics where the continuous rise may be pausing due to various factors. Luke further mentions that this slight downturn might be linked to technical issues, despite the seasonally adjusted numbers hitting a record high for the 16th consecutive time. Examining regional trends, we see that the Northeast and Midwest are still on a growth trajectory. Both regions reported increases of 5.7% and 5.4%, respectively. However, it's noteworthy that the South region is lagging behind, marking its slowest growth rate in over a year at just 2.8%. Understanding these regional variations can provide valuable context for prospective buyers and investors. It reflects not only the health of local economies, but also the shifting preferences in where people want to live. As we continue to monitor these developments, it becomes increasingly evident how critical it is to stay informed about regional shifts and national trends, especially for those looking to enter the housing market or make investment decisions. Stay tuned for more updates as we unpack the complexities of the real estate landscape in the coming weeks. Your journey to understanding the housing market trends continues here, where we deliver insights tailored to guide your decisions effectively. Today, we're diving into a critical analysis of the CoreLogic Case-Shiller U.S. National Price Index, which indicates a steady 3.9% increase year over year. According to Ernie Durbin, the Chief Valuation Officer for Voxtur, while this spike might enhance homeowners' equity, it's essential to recognize the flip side. Housing is getting less affordable for many Americans. As we address these changes, it's crucial to pay close attention to how the new policies from the Trump administration could impact the housing market. If tariffs on imports kick in, we may see a significant rise in construction costs, exacerbating the challenges of housing supply and affordability. Additional expenses such as appliances and furniture can add to the financial burden when homeowners decide to make a move. Durbin highlights a potential shift in consumer behavior. Rising costs could lead individuals to postpone their relocation plans. The implications of these changes could ripple throughout the economy, affecting how homeowners navigate their equity and consider potential purchases. As we look ahead to next year, these policies will be in full effect, allowing us to gauge their impact on housing affordability through the index. Keep your eyes peeled as we continue to monitor these trends and their effects on your real estate decisions in this evolving market atmosphere. By understanding these dynamics, we hope to bring clarity and guidance to your investment strategies. Stay with us as we keep unpacking the complexities of the real estate landscape, providing you with insights that matter.